Wharton School professor of finance Jeremy Siegel joins us now. We also got that jolt this week thanks to China, and I wonder how much of a game changer you think that could be for global markets, given what we've heard.
Yeah, definitely. I listened to David Tepper, and wow, I mean, he makes a lot of sense. The only way, a little bit I disagree with him, is that, I think you can ride Japan for a while. He was worried about a very long term if an appreciation hurts their exports and raises interest rates. But in the meantime, you get a double whammy with a rising yen. And I mean, take a look at yesterday. You got 2% on the yen, 2% on the Nikkei. And so you really got a 4% gain. So I think that could be ridden. I think what China is doing is very positive. And listen, his philosophy, I mean, you can't go very wrong when you buy a market at 10 price-earnings ratio. I mean, unless you think that Chairman Xi is going to abolish private enterprise, and that doesn't look like where they're going right now.
No, but you don't really know.
Yeah, you don't really know. And obviously the bears on China, are going to say, it's just going to go downhill. And his attitude is not certainly as capital friendly as people hope. But, Warren Buffett always used to talk about, that margin of safety that he gets by buying a low PE market. And the China market, I mean, now it's probably 12, 13 PE, but it was 10 PE for a year. It was around the lowest in the world. I think Brazil was the only market that was actually lower than that in terms of price-earnings ratio. So, yeah, I mean, he makes a lot of sense. I think he makes a lot of sense. And the U.S. is expensive. We've had the best growth. I'm not bearish, but where do you think the best gains are? He even mentioned Europe. That's a 15, 14 PE ratio. Again, in the long run, that is usually a very, very favorable factor for returns.
So you think the U.S. market looks full here?
I mean, it looks. Listen, I love the new trajectory of the Fed. I think they only need. I mean, that they can do. If they do a quarter point every meeting, we're going to be at 3.5 by the middle of next year. And by the way, that's where I think the Fed should be, 3.5. Actually, the Fed's, dot plot talks about 2.9 is it long. I don't think it's going to ever get that low unless we have a recession. That's not really an equilibrium. But 3.5, all we need is a quarter point. The next 6 meetings, which gets us to the June meeting next year, that's where we should be. That
based on the inflation.
Yeah,
based on the fact that inflation's come down so much, because we're still not at target.
Yeah, the inflation data. I mean, I think he's on they're on a. They don't have to do 50. I mean, I would prefer I think the data says they should be at 4. So they're going down a little slower, but much faster than it looked like before the last meeting. So instead of getting to 3.5, 4% in 2026, a quarter point is they're going to get there probably in the middle of 2025. And, you can say, well, how much harm is the economy going to be in? It's maybe a little bit too high for a few months. But if they're going to get there and the market thinks they're going to get there, the rest of the year does not look as bad. One reason why the long bond went up, which doesn't surprise me at all, is that recession risk is lowered by the pivot or the recalibration of the Fed.